From April 2027, the government will demand almost half of your retirement savings, and you have no choice but to hand it over. If you're under 50, saving into a pension, this will quietly become the biggest tax you ever pay. And your family will be the ones holding the bill. Most of the business owners I work with had no idea this was coming. So in this video, I'll show you exactly what changes after April 2027 and what you can do between now and retirement. Let me start by showing you why these new rules are probably more relevant than you realize. According to government figures, the number of families paying inheritance tax, or IHT for short, is going to double by 2030. For the first time ever, ordinary middle-class families will end up paying this tax without actually feeling or getting any richer. The recent changes to pensions are a big part of why this is happening, and the situation only gets worse over time. You'll see what I mean in a moment, but first let me walk you through how the system works today so you can see exactly what's changing. Let's say you're sitting at your kitchen table on a Sunday afternoon. You've got a house, maybe it's worth around 400,000. A bit more, a bit less, depending on where you live. You've got some savings, an ISA, maybe a few investments, and at some point you start asking yourself what actually happens to all of this when I'm not here anymore. And I don't want to sound dramatic, I hope you don't have to ask this question anytime soon, but sooner or later, all of us have to face it. Well, here's what happens in practice. When you pass away, someone, usually a family member or a solicitor, has to add up everything you owned. Property, land, savings, investments, vehicles. They call this your estate. And you don't pay any tax on the first 325,000 of it. Everyone in the UK is entitled to it, and it's called your nil-rate band. This is actually an important number to remember because I'll be using it throughout the video. Now, 325k doesn't go very far in 2026. The average house in England is almost 300,000 by itself, so if you own a home, you hit that limit very quickly. The taxman knows this, which is why there is a second allowance on top. It's called the residence nil-rate band. If you own a house and you're leaving it to a direct descendant, such as children or grandchildren, the government hands you another 175,000 tax-free. There is a catch though, as there always is with tax. If the value of your estate exceeds 2.35 million, you lose this allowance altogether. But in practice, most people have the 325k by default, and then you can qualify for the additional 175k to get your total tax-free threshold to 500,000. $500,000 sounds great. And if you're married, it gets even better. You and your spouse can put your allowances together, so as a couple, you get up to £1 million tax-free. I'll show you how this mechanics works in a second. This 1 million combined allowance is actually the best case scenario, and that's why only about 5% of the households in the UK currently pay inheritance tax. So why is the government forecasting that number to double by 2030? The elephant in the room is your pension. Right now, your pension sits in its own little corner of the tax system, completely separate for everything else I've just described. It's not part of your estate, it's not measured against any of the thresholds, 325,000, 1 million. When you pass away, it goes directly to whoever you've nominated, and HMRC doesn't take a penny. But again, there is a small catch. If you die after age 75, the recipient of the pension benefit needs to pay income tax on their own tax rate, either 20, 40 or 45 in England and Wales. And to be fair, this is not a new rule. What is new, however, is that from April 2027, pensions will now become part of your taxable estate. So what does this mean for you? It means any pension money you haven't spent by the time you pass away gets added to your estate along with everything else you own. So the same pension pot can technically get taxed twice. Inheritance tax at 40% on the unspent portion, and then income tax for the beneficiaries if you die after age 75. But the pension change isn't the only thing that's going on here. There's two other forces that are pushing more families into this tax every year. The first is frozen thresholds. Both the 325,000 nil-rate band and the 175,000 residence allowance have been frozen, and the government has confirmed they'll stay frozen until at least 2031. The second big factor is rising house prices. The OBR expects property prices to keep rising by around 2.5% each year. And on top of that, you've got pension pots that have been quietly building since auto-enrollment started in 2012. Every employee earning above the minimum has been paying into a workplace pension automatically. 5% from you and 3% from your employer every month for years. And if you're self-employed or running a limited company, you're probably saving for retirement through a SIP or a similar setup. For someone who started saving at age 25 and retires at 65, doing just the legal minimum, that pension pot reaches around 150,000 on average. For high earners, it can reach up to 300 or 400,000, depending on how much you put in. So you've got frozen thresholds, rising house prices, and pension pots quietly building behind the scenes. Three forces all pulling in the same direction. And if you want to see how close you are to paying this tax, add up the following three numbers with me. It should be very easy. First, what is the value of your property? Not what you paid for it, but what it will sell for tomorrow, because that's the number HMRC uses. And if you own a house in your mid-30s or 40s, think about what the property might be worth in another 10 years at 2.5% annual growth. Second, estimate what will be the value of your pension pot at retirement. How much are you and your employer contributing? If you run a business, how much are you contributing yourself? Well, average pension pot in the UK is around 150,000, and you can use a pension calculator to estimate what that number will be for you. And finally, add your savings, your investments, your ISAs, any assets that you own. These three numbers should make up the bulk of your estate. And if you're single or unmarried, once you add them up, you're probably already close to the 500,000 threshold, assuming you also qualify for the residence allowance. If you're married, things get a bit better. You can transfer all your assets to your husband or wife completely tax-free. On top of that, when the first spouse dies, any allowance they didn't use gets passed on to the spouse who's still alive. So by the time the second spouse passes away, both allowances can be added together, letting you leave up to 1 million to your kids tax-free. So whether you actually pay inheritance tax comes down to three unpredictable factors: how long the thresholds will stay frozen, how much your house will appreciate, and what your pension pot grows to. Oh, and to a large extent, whether or not you get married. We don't know these answers, but here's what we do know. The main thresholds hasn't moved in 17 years, house prices have roughly doubled in the same period, and from April 2027, your pension joins the calculation. You don't need to know the exact numbers to see where things are going. And there's actually one more thing about this new rule. It doesn't apply to every type of pension in the same way. It actually ends up hitting today's working generation the hardest. Here's why. There are broadly two types of pensions in this country. The first type is called defined benefit, or DB, sometimes known as final salary pension. The way it works is very simple. You do your career, and when you retire, your employer pays you a guaranteed income for the rest of your life as a proportion of your final salary. Doesn't matter how long you live, the money just keeps coming until you pass away. In 2026, defined benefit pensions are effectively closed for new members in the private sector because they turn out to be too expensive for employers. It's worth noting that some public sector roles still offer them, but the pension type most employees and business owners are paying into nowadays is the second kind, called Defined Contribution Scheme, or DC for short. Instead of a guaranteed income, you build up a pot of money over your career. You contribute, the pot gets invested, and by the time you retire, it's worth, well, whatever it's worth. Could be 100,000, could be 400,000, depend what you put in and how the markets perform. And here's the key point. It's the second type of pension that gets put into your taxable estate for inheritance tax. The first one stays out for the most part. Although some death benefits can be brought in the calculation, but in general, if you're retiring this year on a defined benefit pension, so the first type, the rule probably doesn't touch you. But if you started working around 2012, when auto-enrollment put millions of workers into defined contribution schemes, the new rules definitely affect you. Conveniently, the 325,000 nil-rate band was introduced around the same time, back in 2009, and it's been frozen ever since. And from April 2027, those frozen thresholds apply to the same pension pots that millions of workers were funneled into. So, auto-enrollment, frozen thresholds, pensions now inside the estate, three separate decisions made over 15 years, all of which conveniently land on the same group of people. So you're probably wondering what you can do between now and retirement. And before I get into this, I want to make it clear that everything I'm about to share is a starting point for a conversation with a qualified advisor, not advice in itself. Pension planning is genuinely complicated, and the right answer depends on your specific situation. Another important thing I want to make clear is that I'm not recommending you to cancel your pension because of the recent changes. Pensions are still one of the most tax-advantaged ways of saving money, and you should consider them in your retirement planning. With that out of the way, there are several strategies to reduce or even wipe out an inheritance tax bill. Many deserve a video of their own, but I'll cover the basics here. One of the most popular ways to soften the blow of the recent changes is simply to spend your pension earlier in retirement. For the last 20 years, the standard advice has been very simple. Spend your ISAs and savings first, save your pensions for last, pass it on to your kids tax-free. Well, from April 2027, that approach is outdated because unspent pension pots will be hit with 40% IHT and potentially income tax on top if you live longer than 75. Therefore, you might actually want to start drawing down on your pension earlier and use that money to start gifting to your children while you're still alive. Well, here's how gifting works. If you give a cash gift to your child and you survive for 7 years after, that gift falls completely outside your estate. This is what they call a potentially exempt transfer. On top of that, there is a separate 3,000 annual exemption. That's a smaller amount you can give away every year that drops out of your estate immediately. No 7-year wait, no conditions attached. The two actually work very well together. You use the 3,000 every year, and on top of that you make larger cash gifts that start the 7-year clock. And to be fair, there are a few other types of gifts you can use as part of your pension planning, but they deserve a video of their own and it'll just make the list too long to explain here. Therefore, the first strategy is very straightforward. Withdraw earlier, gift money to your children, reduce your taxable estate. Another option is to use your pension pot to buy a lifetime annuity. And here's how it works. You hand over your pension capital to an insurance provider, and in return, they pay you a guaranteed income for the rest of your life. The income, however, is taxable like any other pension income, but the capital itself is gone from your estate depending on the annuity you buy. I'm not going to cover all different types of annuities and how each one may affect your retirement planning, but it's worth looking into it and talking to a qualified professional if you think they're the right choice for you. There are other strategies that sit outside of the ones I've already talked about, such as business relief, setting up trusts, getting life insurance written in trust, but those are topics that are outside the scope of this video. The point of this one is what you do with your pension pot when you retire and how to soften the impact of these new rules coming from April 2027. And if you're thinking about retirement, you probably want to keep as much of your income as possible and pass on as much as you can to the people you love. And if you run a business, being tax efficient ensures you keep everything you're entitled to. So watch this video next, where I break down 31 legal ways to extract value from your limited company.